After acquiring over 337 units and over $50 million in multifamily real estate, I can tell you with certainty that the number one barrier that most people run into when trying to break into multifamily is they fail to develop the skill set to properly underwrite and evaluate a multifamily deal. What I mean by this is most people want to jump into multifamily and go fast, so they don't take the time to actually understand how to analyze a deal and assess all the risk and the upside that a potential property could have. Here's the good news. In this video and the next couple of videos to follow, I'm going to be breaking down the exact step-by-step process on how to underwrite deals properly. Now, if you're new to the channel, my name's Gabe Bowling. I'm a 27-year-old real estate entrepreneur based out of Tampa, Florida. And yes, it's actually true. We've acquired over $50 million of multifamily over the last couple of years using the syndication model. In today's video, we're going to go through the framework of how you should be looking at a multifamily deal. The reason we're starting here is because before you ever jump into an underwriting model or even start practicing on deals in your own backyard, it's extremely important for you to understand the why and have the right perspective when going into the business. So with that being said, let's go ahead and let's jump in. Before I even show you the whiteboard, I want you to imagine that you're sitting in front of your computer and you get an email from a broker. It says new 16-unit deal just listed for sale in your backyard. And it has the right indicators that this could be a potential deal. It looks good. You want to take the next step on it so you can confidently know what price you'd have to pay for it to make a bunch of money. Very first thing that I'm looking at whenever the deal comes out, and I know it's something that we could potentially buy, the very first thing I want to know is two things. What is the current condition and what is the current income? So what do I mean by condition? What does the exterior look like? What do the roofs look like? And when were the last time it was replaced? What do the interior of the units look like? Is it the same cabinets that existed in 1980, or did somebody else recently come in and renovate it? What is the proposed business plan that we would have to do as value-add investors to go in and add the value? That's what I mean by current condition. And then current income is extremely important because in multifamily real estate, really all commercial, it's not valued like single family homes where it's based on the comps around the street and what the other guy paid for it. Multifamily real estate is valued on the current income that the property has. And this matters a ton to me because it's going to dictate two things: how much of a loan it can qualify for. And if you take purchase price minus loan, that dictates the amount of equity that I'm going to have to raise from investors. So again, the first thing I'm looking at whenever a deal comes out is one, what is the current condition? And then two, what is the current income? Now moving on to step number two, which I've already briefly mentioned. So we're buying a piece of real estate that has a current condition, current income, and we're in the business of forcing value or adding value to the property, and then either selling it or refinancing it on the back end and making all of the profits. And so that middle part right here is what I'm referring to, is value creation. There's one way to increase value on any of these types of assets, and it's simply an NOI increase. NOI stands for net operating income. All of the income that you're collecting at the property minus the operating expenses that it takes, like taxes, insurance, property management fees, pest control, and all of that stuff. So all of the income minus the expenses equals my net operating income. All I'm focused on as an investor is the bottom line. The bottom line is NOI. How do we actually do this in this business? It's through two things. Most of the time, it's through rent increases. After we're going in, we paint the exterior of the building. We go in and renovate a unit that has white appliances and old flooring, and we replace it to a nicer upgrade, and the market allows us to rent it for a couple $100 more. Also have expense reductions. Oftentimes, especially on smaller deals, the owners that have owned it for 20 years and it's an individual owner that also manages it, they're not managing it like a professional property management company. Oftentimes, there's a lot of low-hanging fruit that you can eliminate from the expense load to increase your NOI. And then moving into the last step of this framework, which is determining your future value, how much you could sell the building for, and how much money would be able to be made for both the investor that put up the money and you for finding the deal and executing the business plan. In multifamily, we're buying NOI, we're doing something to it, and we have a future net income. That dictates value by dividing it by a cap rate. So future value, let's say I bought a building for $1 million. I increased the value to $2 million. We sold the building for $2 million. We pay the loan off, whatever it was, and then the rest that was left over, we would split between the investor and us. And this is where all of the money is made in this business. Recap from the top all the way down. Whenever a deal comes in, you like what you see, it looks good on the surface level, and we want to begin to analyze it and figure out what price we could pay for it. Here is the framework that you should be looking at it from a high level. Number one, what is the current condition? And then what is the current income? The current condition will allow us to put together a specific business plan for this specific deal. The current income will dictate how much of a loan we can get on it, which will dictate how much equity we have to raise, which dictates returns. Number two, the value creation. So based on the current income, what can we do to it? And how much can we increase the net operating income right here? Based on us being able to go in and increase net income, what's the future value of this asset? So that way we can look at it from both the perspective of selling it and then potentially keeping it and doing a cash out refinance. Determining future value, selling it, paying off the loan, and then a profit split between you and the investor. Is there enough money left over for everybody to be happy? All right, so now that we're back, hopefully by now you have a really good understanding of the framework of how you should be looking at multifamily deals. If you've done anything in single family homes, it's really not different at all. The only thing that's different is how you value it, which is why it's so important to understand the numbers. And now moving on to the next video, I'm actually gonna show you a 28 unit deal that we just closed on last month. I'm gonna walk you through the exact underwriting on the whiteboard, every single step in the way, and make the decision with absolute confidence that that property was worth $3.9 million and could be potentially worth $6 million or more once we're done with it. I wanna keep going and take the next step and dig deeper into what it actually takes to underwrite these types of deals, and click the link to the next video and I'll see you there.